Right, hello everybody. Thanks very much for listening to the Trendsignal Podcast. It's the 20th of March 2023, and as ever, I'm joined with Jerry Miller, Managing Director of Trendsignal. My name is Adrian, and today we're going to be talking about what's going on with the markets at the moment. Bit of a banking crisis; it's spreading at the moment. Jerry, do you want to just tell us a little bit about what's happened over the last week or so?
Gosh, a lot has happened. I mean, it was this time last week that we thought perhaps the banking regulator in the US had probably sorted it, and I think the Biden administration went onto social media, etc., to claim the plaudits for getting it sorted. But actually, here we are a week later, and it just got worse and worse. The Federal Reserve, you probably don't know this, but it's also responsible for regulating the banking sector. And I think it was pretty certain that it had taken decisive action last week with Silicon Valley Bank, SVB, and we talked about all the stuff that was going on there. But since then, another bank, Signature Bank, that failed. It had a sort of similar profile to SVB. And then you've got this other bank, First Republic. I think it's based in San Francisco. It was obvious it was having trouble because the Fed publishes this data. It borrowed 100 billion from the Federal Reserve because First Republic's customers were rushing to withdraw their funds. But last Thursday, a consortium of banks headed by JP Morgan decided to also help out First National by depositing 30 billion of their own funds with First Republic. I'm not sure altogether what might happen to them, but I know the stock price by Friday night obviously hadn't recovered, because you can see what happened to the stock market. It did peel off on Friday. It had a good day Thursday, but peeled off on Friday. And I think First National was down 73% by the close on, or 72% by the close on Friday. That's close on the week, I should say, but it fell 33% on Friday alone. So what's going on? It's all to do with bad bank management, really. Badly run banks like SVB. And just to give you a brief explanation, Adrian, let's just work out what SVB had done wrong. They had taken in deposits of about $180 billion from, they had a lot of tech customer firms based in California that deposited huge amounts of money with them because they gave slightly better interest on people's money, customers' money. So SVB had this fairly cheap form of funding, and with those funds, they then bought long-term treasuries. And a year and a half ago, or a year and 2 months ago, the yield on those long-term treasuries were quite a bit more than you had to pay a depositor. That's a win. Fantastic. The problem with depositors is that they only leave their money for as long as they leave it there. They can turn around and just take the money out. And that's exactly what happened with SVB. So SVB lost all their depositors, and at the same time, for some weird reason, they didn't hedge their bond portfolio. What I mean by hedge it, they didn't protect it against bonds collapsing, which they have done when Mr. Putin and Russia invaded Ukraine and inflation went through the roof.
Yes, I mean, they should have, easy to say in hindsight, but if they'd have hedged it, then they'd have been mitigated in the risk of the bond prices going down. They'd have made less money, of course, but then I suppose in order to pay away better returns, they probably needed to try and maximize their possible profits, and in doing so, took on too much risk.
When you say if they had done, their shareholders would still have some value in the company, and we wouldn't have a banking crisis. But there are other banks of a similar profile. What you have to remember, Adrian, is we know the big banks here in the UK, and the other smaller ones are called challenger banks. In the US, there's something like 120 banks. Lots of state-based banks, lots of regional banks, and these are still huge banks in comparison to ours as well. So, it's a problem. Anyway, so what happened from then? We then thought, well, this is a US problem. Well, this doesn't really affect Europe. But of course, gradually people started to focus on Credit Suisse. Credit Suisse is a Swiss bank that has been beset with problems, with a business sort of model that wasn't particularly working. It had a couple of scandals, money laundering problems, etc., and it was the first one that traders here in Europe focused on. And the stock price started to fall. The cost of insuring Credit Suisse debt went through the roof, and that's like a big sort of flashing light for a company, certainly a bank that is struggling. And I think it was, I'm not sure, I think it was Saudi National Bank was the one that commented last Thursday that it would not be able to support Credit Suisse any longer, and the stock price just absolutely sank. Anyway, come Friday, it was clear that the Swiss National Bank, that's the central bank in Switzerland, decided it had to act, and it brokered an agreement. Actually, sorry, before that, Swiss National Bank actually offered and said that it would provide $54 billion in liquidity for Credit Suisse, but that was never enough, because that's just giving them money. They're still using it unwisely, and I think the banking community and the investing community realized that Credit Suisse was whole below the waterline. Anyway, over the weekend, UBS, Switzerland's biggest bank and a very well-known bank to everyone listening, I'm sure, ended up acquiring Credit Suisse on pretty good terms. Certainly about a third of the value of the bank that was its closing price on Friday night. The problem with all of this, if you want to know the big problem, is it has not put the fire out. It has not stopped the banking crisis as far as we can see, not yet anyway, because what they agreed to do was to buy Credit Suisse, but they wrote off all of this AT1 tier capital, these AT1 bonds. That's A for Apple, T for Tommy, not 80 as in the number. This is debt that is designed to sort of act as a cushion in a bank's balance sheet, and it absorbs the losses when a bank gets into difficulty. But I think the surprise on Sunday night was that they wrote the whole lot off, and that caused panic overnight in Hong Kong. And the likes of HSBC and Standard Chartered, two big Far East banks that are also listed in London, have the main listings in London, they fell 7%. I'll leave you to carry on here, Adrian, because this is a complicated story.
I mean, panic because clearly this is a much deeper problem than first foreseen. And actually, I guess, you said at the beginning of this podcast about the US administration and Biden saying that they've taken control and they've resolved the problem. I mean, that's a pretty naive statement to have made surely they must have expected some contagion to come through.
Yeah, well, I think certainly it's turned out to be that way. But I think at the time they were hoping that it was they'd sorted it. Yeah, well, hope is not a strategy, is it? But I'm a little bit surprised that it's got out of hand as much as it has done. And a number of big private equity group managers have said that they think this is going to be a car crash in slow motion. With more and more news and data coming out that undermines more banks' credibility. And this is something these regulators have got to get a real grip with. For the time being, it's sort of isolated within the banking sort of sector, but it has wider implications for all of us. Absolutely, it does.
Absolutely. Okay, so let's have a quick look at what that means for us in the markets. So the FTSE is the chart I've got on here at the moment. I brought that up for a reason, Jerry. And it's got a large banking sector, isn't it? It's very overweight, if you like, in banks. That's why we've seen it come off quite a lot more than other markets, haven't we?
Yeah, apart from anything else, it's got HSBC, which is Europe's biggest bank. So when you look at how the FTSE behaved compared to the likes of the DAX, the DAX was still weak last week. But when you look at the FTSE, that came off over 5.25%, whereas the DAX was just over 4%. But that's just down to the makeup. It's not because the UK economy is any worse than people have said it is.
Yeah, there's just rather more banks in there as opposed to like the blend that's within the index. And you compare that with some of the US indices. Actually, they performed quite a bit like the NASDAQ, for example. That performed a lot better, didn't it?
Yeah, remember the US indices, they took a big hit the previous week. And then you had that big recovery on Thursday last week, the large green candle there, Adrian. But that went south on the S&Ps, but the NASDAQ, remember, that's mostly made up of technology stocks. So that NASDAQ definitely outperformed because it's not really interested in banks, quite frankly. So that's the reason why it outperformed. Whereas the Dow Jones, it was virtually unchanged on the week compared to the S&P 500, which is a very broad index that was up 55 points, because the Dow's got a couple of banks in its index. Remember, it's only 30 stocks as well.
Yeah, exactly. Okay, and what about on the currency side, Jerry? What sort of movements have we seen there?
Well, one of the issues with what's been happening last week is something called a flight to quality. So this is where investors are absolutely panicking out of banking stocks. I remember every money manager of his salt has got an investment in a bank. They are great. They've been great outperformers over the last 6 months. Banks have done really, really well as interest rates have gone up. The margin that these banks are making has increased. Okay, they get bad debts and stuff, but this is a whole different ball game. This is something fundamental to banks' existence. And what's happened with the bond markets is that yields have gone down as bond prices have gone through the roof. Investors are flooding into the bond market, one as a way of parking their money in a safe area rather than keeping it with banks. Number two, they expect the Federal Reserve not to be raising rates anything like as much as they were just this time last week.
Yeah, that's been a big change, isn't it? So we bring up the Fed Fed Watch tool here, and this just explain this, Joe. But this gives us an idea about the likelihood of any interest rate change and what's been priced in the market. So just want to quickly explain this for us.
Yeah, so each of the dates on the top left is the date of what we call the Federal Open Market Committee or the Federal Reserve's monthly policy meetings. We call them monthly. They're not every month, as you can see. They were at one in March, May, June, July, September, November, and December. So there's roughly 8 meetings in total a year. But it tells us what the market is expecting interest rates to be on the date of those meetings. So, i.e., what we're expecting the Fed to do by those meetings. Currently, just above that red dot, it tells you what the current rate is at 4.5. So they have a target range. They don't just have one interest. So they target the Fed funds rate between 4.5 and 4.75%. So that's what it's at the moment. So if you look down at those two bars there, there's a 40% chance that it's going to stay at 4.5 to 4.75%, which, given where we were a week ago or 2 weeks ago, we were expecting an interest rate hike of 0.5%. So in the space of 10 days, it's just shifted absolutely dramatically. It's turned on its heels, as it were.
Well, we can see that on this tool as well from the FT that the change over the last week, the change over the last month. It's the 2 years we want to look at, isn't it, Jerry?
Yes. So the 2 years sort of is a lot more tied to what the Federal Reserve are doing with interest rates. 2 weeks ago, the yield, the return you got on a 2-year note was above 5%. Now, 3.69%. There's just been the most dramatic turn. I think the FT was saying that bond yields fell so much on one day that there hasn't fallen that far since 1987. I think the last record was set. So you can imagine how hectic these bond desks have been in these various brokers and banks over the last week. It's just been pandemonium. And the 10-year yield as well, which is something that we track quite closely. So if you just move over a couple of notches, there we go. That's currently at 3.3%. That was at 4.05% 2 weeks ago. Just so you know, to put it in context, to move 0.05% in a day is sort of average. A movement of 0.3%, 6 times as much. That's what happened last week in a day. So you can understand this sudden earthquake, a shift in sort of expectation. Now we're no longer expecting the Federal Reserve to raise rates anything like as much by year end. We are now or the market, not we, I'm not forecasting anything, I daren't, but the market is now expecting year end rates to be around 4%. So if you go back to that Fed Watch tool again and go to December, look at that. We were expecting them to be at 5.25% 2 weeks ago. It's just the most dramatic. Okay, you asked me about the dollar, and the reason why the dollar has fallen is because investors, putting it bluntly, investors aren't going to get such a good return on their money, and for that reason they're moving out of dollars, and that's all it is. It's you don't get such a carry on your on your deposits in the US if interest rates are going to be coming down by the year end. And that's the reason why sterling rallied. That's the reason why the Japanese yen rallied. When you look at the Japanese yen, remember we're pricing in the number of yen to the dollar here, so that's not the yen falling, that's the dollar falling against the yen.
Yes.
The euro, a different kettle of fish. The euro, you're looking at gold there, but if you look at the euro, sorry, I'm flying around here, Adrian. You're doing very well keeping up. The euro,
Thank you.
we had the European Central Bank out last week, and they raised rates by 50 basis points or 0.5%, as expected. Some people expected them to perhaps not raise rates by a half, maybe 0.25%. But I think, they're stuck to their guns. And I think the view was the view that this banking crisis was more of a US issue. I think obviously 2 days later from when they made that announcement, it obviously has come a lot closer to home with Credit Suisse failing and then falling to its larger Swiss rival. But cut a long story short, the European Central Bank said that they would react. They would not give any guidance anymore, and they would react to the data from 1 month to the next. It basically was a more dovish response than a lot of people were expecting, and that's the reason why the euro has not rallied as much against the dollar as other currencies like sterling and like the yen.
Okay, that's great. Thank you, Jerry. Let's very quickly just have a look at some commodities. So we've got gold and oil specifically. You mentioned flight to quality. Is that what's happening here? Obviously, that's gone pretty great guns in the last week, up about 6%, isn't it, gold?
Yeah, I mean, gold. I've when it moves, it can move dramatically. But if you look at some of those candles over the last 6-7 trading days, Adrian, I mean, gold is now pretty much up at its all-time high. I mean, you'd have to really put up the monthly chart just to see it. But it's a classic flight to safety. Investors are putting their money into gold because they don't trust what's happening with banks. It's an easy sales story. You can imagine all the bullion desks, they'd be telling all their customers, you've got to buy gold, you've got to buy gold. And up it goes. Similar to the bond markets, it's a big move into gold, into bonds. And we've, at the $2,000 level, Adrian, and I think last time we hit that was back in, when was it? April 2022. And yeah, we're pretty close to the all-time high. Anyway, you've moved on to oil.
I've moved on to oil. Yes, exactly. Just quickly, what's that about? I mean, that's a significant fall in oil as well. So
yeah, everyone keeps asking me about why doesn't petrol and diesel come down, and I've got no answer to that apart from the oil companies and the retailers love making money out of us. But no, oil has collapsed, absolutely collapsed. $10 last week. What are we down today? Okay, it's rallying a little bit. We were down $2.70 about an hour and a half ago. So yeah, it's improving along with the equity markets as we speak. But yeah, it tracks the path of global economic activity, really, Adrian. And I think not only did it suffer on the back of the slump in equities last week, there was all this flight to safety issues, but I think the data in China has not been brilliant. I think a lot of optimists were expecting China to rebound a lot more strongly than it has done, and I think that's sort of spiked the market a little bit. And a lot of the hedge funds have all been heavily long of crude oil, Adrian, and I think you're just seeing that reaction as they unwind those long positions, really.
Yeah, indeed. Okay, Jerry, that's great. Let's have a quick think about the what don't we know yet? So this is the idea of what economic data announcements are there for the next week. What do we need to be wary of, or what potential banana skins there are? So do you want to just take us quickly through the calendar, Jerry?
Yeah, well, if it's not enough having a banking crisis unfolding as we speak, or maybe not unfolding, maybe it's starting to recover, I don't know, but it's caused a lot of problems in the markets that we've just discussed. But this week, we've now got interest rate decisions from the world's most important bank, and that's the Federal Reserve on Thursday. We'll head straight to that now, and I'll then flit and whatever. I won't do it chronologically, but sorry, not this Thursday, it's Wednesday.
It's Wednesday, and crucially, it's at 6 p.m. because we're slightly out of sync with the US with their daylight savings change from last sort of 8-9 days ago. But that's so just take us through that. So that's pretty the major data item for this week, isn't it, Joe?
Yeah, you're correct to highlight the fact that we've got a 4-hour difference with us and the US for the time being, but that changes this coming Sunday when we go back to the usual 5 hours. So yeah, make sure you're around at 6 p.m. on Wednesday, not 7, because you'll have missed it if you suddenly wake up at 7 o'clock in the evening. But yeah, the Federal Reserve key event of the week, they're likely to raise rates by 0.25%, or are they? It's a 50-50 call. Goldman Sachs thinks they're not going to. So there are
It's
other.
moving. It's a constantly moving thing. Keep an eye on the Fed Watch tool. So just if you want to on Google, if you're listening to this podcast, hopefully some people are, then just search for countdown to FOMC and you'll be able to get all of that to see what their expectations really are from the markets, basically. In terms of traders, Jerry, really, end of day traders, relevant markets, dollar markets, indices, probably worth being out of trades before that. And certainly for day traders, there's likely to be a big reaction from that data, whatever it happens to be, with portfolios being adjusted and so on. So it's going to be an interesting time.
Other than a presidential election in the US, interest rate decisions are absolutely key. So yeah, I just endorse what Adrian's just said. Just be very, very careful. In terms of
going to say Switzerland on the Thursday, and then we've got the UK on Thursday as well. Not likely to be as high impact as the States, obviously, but how important are these for us?
No, well, that's right. Well, quickly, the Swiss National Bank, they're going to be raising rates by 0.5%. Maybe they do a quarter, we're not sure, but I think they'll follow the ECB. But we're interested in the MPC because a lot of us live here in the UK, and we believe now that the odds are 50-50 between no change and a quarter point rise. Go back a week ago, and they were, we were of the firm belief that they were going to raise rates by 0.5%. And it's
good if you've got a variable mortgage, I guess, isn't it, or better?
Well, yeah, that's right. With bond yields coming down as well, that makes a big difference to anyone looking to secure an offer from a mortgage provider. You're going to be getting a lot better rate than you would have done 3 months ago. But they've got a difficult task, the MPC, because data last week, or not last week, previously on the economy has improved. We got a better public sector borrowing requirement. Our GDP was better than expected, basically better than everything that the IMF and the OECD and even the Bank of England were suggesting. So please don't do our economy down too much just yet.
Yeah. Jerry, that's great. Thank you very much for that review. I think we'll leave it there. I've got a couple of other bits that I want to go through, but yeah, thanks for being with us. Thank you.
Yeah, okay, good.
So what I'm going to do is just have a quick look at the charts, have a look at what we've been trading, what we're looking at. It's been a good month, March so far. I mean, a lot of volatility. For our D1 sniper strategy, we're up about 1,700 pips. That's relative to our what we call starter targets. That's up about 11.6%. So really happy with that. Good month there. Some interesting moves. Let's have a quick look at the FTSE, which is one market that I did want to have a quick look at. It has been coming off a lot. And it's at times like these when you start to think that, oh, okay, does that mean that it is a good time to be buying it? Certainly, a lot of people are. You look at the retail position or the sentiment from IG retail clients, they're net long, about 75% long on their FTSE traders. So what you'll find is as markets start to break down like this, the number of people, the number of participants in the market will start trying to catch a falling knife, as it's called. So the market keeps coming off in free fall, trying to catch it, trying to catch the low, and then continuing to increase their positions as it goes down, what's called averaging in. We are certainly at a stage where the market is quite oversold. Is it the right time to be buying that now? It's difficult to say. One of the things you can do is if you look at the daily FX client sentiment report, I always think that's quite an interesting one because it gives you an idea about just the type of positions that people are in. Now, not to be really used in isolation, but if I look at the FTSE 100, let's scroll down to the FTSE 100 chart, and you can see the position from a lot of customers over at the IG broker here. So if you think about this as an example, so last time, so what this line is telling us, so this red line here is turning into blue, suggesting that the customers are generally net long. So as the market falls in price, people tend to start to try and buy at a discount until there's kind of like a natural level whereby you don't really have too many buyers left. What's interesting is, and I'm not saying this is the right time to be buying just yet, but the last time we got up to that sort of 75% level, actually that was pretty much the lows on the FTSE. So we're back towards that overbought kind of level. Say overbought, what happens is that, you know, you get to a stage where as the market keeps coming down, more and more people start to buy, and retail traders will generally start to buy far too early. So you get to a stage where pretty much everybody is long that's going to be long. Then everyone's on margin call, start to close out. It's usually when the market then starts to lift. So what you're kind of looking for a big turning point is for basically every retail customer and their dog to be already long, okay? And it's at that point when there's no one left to buy, that's probably more likely to be the time to get involved. So looking at things like the IG client sentiment can be really helpful, really, for us. So do keep an eye on that to help you with your timing. In terms of some of the other things to have a look at, definite support around that sort of 7,400 level. The last time we were down here, if I just look back on the charts, quite a few pivots around that 7,400, 7,350 level there. So you can see the major support level there, 7,352. We're right on that number now. We definitely found a bit of rejection off those lows today. So we'll certainly be interested in looking for a turn off there. Other markets, gold we look at briefly earlier as well. So I'm not going to spend too long on this for the analysis, but the last time we were up here, we're finding resistance off that 1964 level, a key price from which we fell back in April 22. And then the next key level from there is going to be 2025. So expect a little bit of reaction we've already had off that 1964 level. 2025 will be the next resistance level to be aware of from there. So don't be surprised if the market does continue to move higher to see a little bit more profit taking, a little bit of conflict in prices, a little bit of increased volatility. The market's up to that sort of a level. The other, excuse me. The other thing I wanted to talk about today was a quick look at the NASDAQ. I was showing you that earlier. This is a market that's been sort of chopping around a little bit over the last couple of weeks, but some interesting moves really. This is one like Jerry mentioned earlier, it doesn't have the banks in there. So in fact, you could argue it's a little bit cleaner, maybe in a way. And it's not so manipulated by the external factors that are happening at this point. Some interesting trades over the last couple of weeks. Market in quite a tight range really, but some interesting profits on this short trade and this move higher as well. So, you know, only for 24 hours the market's or less than moving in those directions. So in a market like this where there's something always going on, it's important to be nimble. So don't, you know, we shouldn't necessarily, in my opinion, as traders, be thinking about being in trades for 3 weeks, 4 weeks, 5 weeks, because I don't think the markets are really behaving like that. Be more nimble with it. Look to take profits that are available before the market can find some new news that could start to move its direction back the other way. This is very classic chart that we're seeing across a lot of currencies at the moment. You're seeing bursts of speed of 2 or 3 or 4 days, and then the market starting to flip flat back the other way. So take the profits where you can is what we're saying to our members. Interestingly, the NASDAQ here finding a little bit of resistance off that the resistance level there. So we had that buy there. Not a great resistance area. So it's a reasonable resistance area. It's from when the market fell quite dramatically a few weeks ago. It's found resistance again off on Friday's highs, and we're just sort of chopping around today. But an interesting opportunity certainly. Like I said, the thing to do at the moment is, in my experience, is to be mindful of the profits you have and don't be scared to take some of those profits off when the volatility is higher, because what you don't want, markets can move on a sixpence extremely fast. We saw that a couple of weeks ago with Jay Powell on that Tuesday a couple of weeks ago, where the market just span off dramatically. We don't really want to be on the wrong side of that and giving a load of profit back to the market. One of the things I wanted to talk about today, so that's very much the what should we be trading. Let's have a quick look about the problem. And one of the problems that I know that a lot of traders do experience is one of trade sizing. So this little feature here, what's the problem? We're only going to talk for a minute or two on this one before we finish off for today's podcast. But one of the things that we see is to do with trade sizing, and the issue to do with particularly trading indices as well. A lot of movement. Indices are very popular. A lot of people think, particularly in spread betting terms, that a pound a point is the same across all markets. It really is not. And let's have a quick think about what that means. So let's say you've got FTSE trading at, say, 1,000. Okay, if you wanted to do that at £1 per point, because a lot of new traders just keep their trade size or stake per point the same. So the notional value on that is the number of points times by the stake you do. So basically means that is a notional value of £7,000. Okay, so that's £7,000 worth of FTSE that you would indeed be buying. If you were to trade a market that was trading at, say, 30,000, and you did that at £1 a point, okay, same similar thing. You just do the equation. If you're going to trade a CFD, effectively that is a £30,000 position. Oops. Okay. So all other things being equal, let's assume they move at similar speeds in percentage terms. A 1% move on the FTSE would be worth £70 profit or loss to you. A 1% move on this market down here, priced at 30,000, would be worth £300 to you, win or loss. The point being is effectively it's what, 4 times the size, okay? 4 times the size because the price is bigger. The stake per point is the same, okay? But what it means is the speed in which your balance, your profit or loss will move, all other things being equal, let's assume they move the same speed in percentage terms, those two markets, then you're going to make or lose money 4 times as fast. So what does that mean to us? It really means that the faster the market you are trading, your stop loss is likely to be wider anyway. You should be looking to adjust your stake size accordingly. So if the market is moving, it's effectively priced 4 times the size, all other things being equal, you really should be looking at trading a fourth of the size on the higher priced market, right? In this case, so the equivalent will be, let's say, 0.25 per point, or 25 pence per point. Now, what's interesting about that is some people then say, well, that's not a lot of money per point, is it? But actually, in percentage terms, in terms of volatility, again, all other things being equal, that's about the same speed of movement, or in terms of money for your trading, than trading £1 a point on a lower priced market. So just be very mindful of that. The stake per point, your stake per point, your pounds per point, whilst it sounds the same, they do not mean the same. The speed in which you make or lose money is determined by the volatility of the market and the price of that market as well. So what does this actually then mean to us? Because, well, Adrian, look, there are some brokers that, the minimum trade size I can do is £1 a point or 50 pence a point and so on. The point about that is that it is very easy for us to feel forced into trading too big size. If it is the case that you want to trade at 25 pence per point because of the risk that you want to take on a trade, then you should be able to do so. Some brokers will try and force you to do that, then trade bigger than that because it's perhaps in their interest to do so. They want you to trade as big a size as possible and so on. But actually, you don't have to play that game. There are many brokers that can quote you from, say, 0.1 or 10 pence per point, which then means that you can keep your trade size nice and low, nice and relaxed, without having to over leverage or over gear yourselves. Why is this important? It's important because if, say, the broker was telling you minimum you could trade was £1 per point, but you wanted to trade at 25 pence a point, that was the risk threshold that you were happy with. And let's say that you were wanted to trade at 25 pence a point with, I don't know, 100 point stop loss, that's going to be £25 risk. The problem is if the broker doesn't let you trade less than £1 per point, what that means is that's 4 times the trade size. Instead of risking £25, if you want to trade with broker X, you'd have to risk a minimum of £100. What does that do for us? That means we're risking 4 times the amount of money than we're comfortable with, which creates all sorts of problems. Number one, you're going to do the trade anyway, and you're going to trade 4 times the size that you should, which probably means it'll end up being a loss-making trade, and you'll start to panic about it, and you'll lose 4 times the amount of money that you should do. Or what happens is that you decide not to do the trade because you think, well, I just can't do it, but then it'll end up being a winner, right? And you'll have missed out on the profit that you would have made otherwise. So it's just Sod's law comes into play. And the good news is that you don't have to do that. Just change your broker. Look for a broker that allows you to trade the size and the flexibility over the size that you want to, particularly in a faster moving market like we're seeing at this point. If markets are moving faster, stop losses are wider, which means unless we can reduce our stake per point, our trade size, then we're going to be risking more capital on those trades. So you want that flexibility to reduce your stake size down a little bit, to keep the monetary risk at a constant on your trades, which gives you greater control over your risk management. So it's really key. So when you're looking for a broker that you want to trade with, lots of people will look at all sorts of different things in order to determine which broker to trade with. For me, the first thing that I look for is the minimum trade size or stake per point. If I'm a spread betting or CFDs, I want to have, and I want our members to have, the flexibility to trade ideally from about 10 pence per point, to give them greater flexibility and control over their trade size, so they're not having to avoid trades or trade too big a size than they're really comfortable with. Okay, and like I said, with the competition that's available in the marketplace and brokers that are out there, you don't have to be forced into trading size you're not happy with. You can choose a broker that gives you the comfort that you want. And that's basically it. Okay, so everybody, thanks very much for being on today's podcast. We wish you every success with your trading, and we'll be back with you next Monday, or for more of the same. All the best, and bye-bye for now.